Have you ever looked at a company's financial report and just felt like you're not getting the full story? Well, today we're pulling back the curtain on one of the trickiest parts of accounting, how companies deal with potential disasters. Risks you can't see on the balance sheet, but that could be lurking just around the corner. So, let's just jump right in with a scenario. Imagine you're the CFO. A letter lands on your desk. You're being sued for $50 million. Now, your first call is obviously to your lawyers, but your very next thought is, do we have to put this massive, uncertain risk on our books right now? And the answer to that is way more complicated than a simple yes or no.
You see, to answer that question, accountants don't just guess. They have a very specific framework they use to take something as messy and uncertain as a lawsuit and turn it into a clear financial reporting decision. It's a process for turning a vague threat into a hard number.
The official term for this is a loss contingency. Now, the most important words on this slide are an existing condition. What this means is the event that caused the potential problem, say selling a faulty product, has already happened. We're just in a holding pattern, waiting for a future event, like a judge's ruling, to find out what the final bill is going to be.
So how do accountants assess that uncertainty? Well, they use this simple but really powerful three-part model. They take every potential loss and sort it into one of three buckets. Is it probable? Is it reasonably possible? Or is it remote? And where it lands changes everything.
Let's start at the top. Probable. This means the bad thing is actually likely to happen. This is the highest level, the highest hurdle. Once a potential loss crosses this line, it stops being just a worry. It becomes real enough that you have to record it as an actual liability on your balance sheet. Now, this middle category, reasonably possible, is huge. It covers pretty much everything that's more than a tiny chance, but not quite likely yet. Now, for these, you don't book a liability, but, and this is key, you have to talk about it in the footnotes of the financial statements. This is the big warning sign for investors.
And finally, we have remote. If the chance of something bad happening is slight, you generally don't have to do anything. And this is just a practical filter, right? Can you imagine if companies had to list every single far-fetched risk they faced? Their reports would be 1,000 pages long and totally useless. This keeps the focus on what really matters.
Okay, so that framework seems pretty straightforward, but this is where it gets really interesting. You see, the world basically runs on two sets of accounting rules, US GAAP for the United States and IFRS, which is used pretty much everywhere else. And depending on which rulebook you follow, you can get two completely different answers for the exact same problem.
And the difference starts with the definition of the word probable. Just look at this subtle phrasing. US GAAP says likely to occur. IFRS says more likely than not. I mean, they sound pretty similar, don't they? But in the world of accounting, that tiny little difference creates a massive gap.
And this table puts some hard numbers on that gap. In the US, likely is generally understood to mean there's a 70% to 75% chance of the loss happening. But under international rules, more likely than not just means anything over 50%. This lower threshold means an IFRS company has to book a loss way sooner than a US company would in the exact same situation.
Now you're probably thinking, okay, this seems easy enough. Just ask the company's lawyer. What's the percentage? Are we over 50% or 75%? Well, it's not that simple. There's this very careful dance that happens between the legal team and the accounting team.
You see, lawyers are trained not to give you a simple percentage. Why? Well, imagine a lawyer says, yeah, there's a 75% chance we're going to lose. That statement could be used against their own client in court. So the American Bar Association has this policy that says a lawyer will only call an outcome probable if the case is a total lost cause, when their defense is, and I quote, extremely doubtful. And this creates a huge problem. The accountant needs to know if the probability is over a certain threshold, but the lawyer, for very good legal reasons, can't give them a straight number. So management gets stuck in the middle, trying to make this massive judgment call based on very cautious, very careful language from their legal team. So let's see how all this actually plays out. We're going to go back to our lawsuit example, and we're going to watch how these different rules send ripples through a company's financial statements, the very numbers that investors and banks rely on.
All right, so management has made the call. They've decided the loss is probable. But now there's another problem. The lawyers say the damages could be anywhere in a range, from $5 million all the way up to $15 million. So what number do you actually put on the balance sheet?
And surprise, surprise, we find another major split right here. US GAAP is very conservative. It says if you have a range, you have to record the minimum amount. IFRS, on the other hand, says you should record the midpoint of that range, as it's the best estimate of the likely outcome.
And this chart just shows you how huge that difference is. For the exact same lawsuit, the U.S. company puts a $5 million liability on its books. The IFRS company, they book a liability that is literally double that, at $10 million. Same facts, totally different financial statements.
And this is the point I really want to drive home. This is not just some academic exercise for accountants. This difference flows directly into the financial ratios that determine everything from a company's credit rating to its stock price.
Let's just take one key ratio, debt to equity. When you book a loss like this, it's a double whammy. Your liabilities go up, and your equity, your net worth, goes down. So because the IFRS company books a much bigger loss, its ratio gets hit twice as hard. Overnight, that company can look way more risky to an investor or a bank. So what does this all mean for you? Well, it means that understanding these rules gives you a huge advantage. It lets you read between the lines of a financial statement and see the risks that other people might completely miss. So here are the key things to remember. First, U.S. rules are tougher. You need a higher certainty to book a loss. Second, remember the range rule. U.S. GAAP takes the minimum, IFRS takes the midpoint. And maybe most important of all, remember that the really interesting stuff, the clues about future problems, often lives in the footnotes under that reasonably possible section. And that really is the heart of it all. The big numbers on the front page of a report are only part of the picture. True financial intelligence comes from understanding how those numbers got there and from understanding the story that's being told in the fine print. The footnotes are where a company tells you what it's truly worried about. So I'll just leave you with this question. The next time you open up a company's annual report, now that you know where the invisible risks are hiding, are you ever going to skip reading the footnotes again?